Hey everybody, welcome back to The Market Interest, where we talk stocks, finance, in the markets. Right now there's a lot more volatility in the markets and multiples are going through the roof. So right now I'm looking for a lot more value stocks versus growth stocks. And I still have a large portion of growth stocks in my portfolio, but I just think it would make more sense based on where interest rates are and where they're heading to find more value companies instead of growth. That's why I own and am considering buying more Smith & Wesson. Smith & Wesson is a firearm manufacturer and has been in existence since 1852. That's 170 years, and that's a really big deal to me. Their product line consists of handguns, revolvers, long rifles, handcuffs, suppressors. Their customer base is diverse. Gun enthusiasts, law enforcement, single-purchase consumers, competitive shooters, and military agencies. Let's start diving into their numbers. Let's look at their market cap. All right, highlighted in yellow is Smith & Wesson. Their market cap, $833 million. So it's a smaller cap company. Because it's a smaller cap company, there's generally more fluctuations within their market price. So there should be a premium for that. Oh, nice. This has a beta of 0.86. And what that means is that you should probably hit the like button just to show support for the page. But what I really like is looking at their beta. They've got a beta of 0.86. If there's a beta of 1, that means there's a direct correlation to the market or whatever index it's following. And if the beta is under 1, that means there's less volatility in comparison. So a beta of 0.86, I like that. I like that. There's less volatility in a volatile market. If we take a peek at their price, right now their price is at $17. Their 52-week high was about $40. They're 129% off of their highs. Everybody says go and buy the dip. This is a pretty big dip, and they had another substantial one just last month. They're 16% off of their 52-week low, which I think is a good opportunity to start looking at some entry points. Let's take a quick peek at the insider buying. So we had 2 purchases within the last month. Not major, not like massive purchases, but still purchases nonetheless by insiders. And they did that right after the company had a pretty substantial dip. Let's take a peek at their charts real quick. So this is the 1-year history of the company. Let me scoot this over a little bit more so you guys can see. There was a dip in December. It was about 30% right off the bat. The company missed a few numbers when they were reporting when it came to the top line and bottom line. Since then, you're seeing that the market's starting to tick back up. People are repurchasing, getting back into it. The good argument lies within their numbers. If we take a peek at some of their multiples, yeah, their PE ratio is only 3. A PE ratio of 3. So that's really, really low in comparison to a lot of other companies out there. You know, you look at Tesla, for instance, their PE is 333, which is crazy. The PE is a price over earnings. So the lower that number is, it's perceived to have more value. A PE of 3 is low, especially in today's environment. It seems like in the 30s is a pretty common place for many companies to be nowadays. If we just take a peek at JP Morgan's Guide to the Markets, here we go. JP Morgan's Guide to the Markets. They have an S&P 500 index forward PE ratio, and their 25-year average is 16, about 7, let's say 17, right? Rounding up. It's at 17 is what the forward PE is. Now, multiples are at over 21. Let's say it is 21. It's at 21. And they've been above for a while now. It's a couple of years now. That's not sustainable for the long term. I think it's wiser to look at more value stocks where the multiples are lower, that companies may be overlooked. And that's why I like Smith & Wesson right now. Again, the 25-year average forward PE is 16 or 17. Well, Smith & Wesson is at 3 right now. Really solid place to be. It's always really nice to see a company where they have a lot of a tangible book value. And right now, Smith & Wesson, their tangible book value per share is $10. All right. And if their stock price is 17, then that means there's a large portion, 58% of their company stock is of tangible value, right? It's tangible value, something that they have physically on a book value that can be sold. All right. So that's great. If the company's in a financial struggle, they're going belly up for whatever reason, Well, guess what? We've got over 57% of that company is covered by just tangible assets on their books. I feel comfortable knowing that they can weather some pretty big storms. Keep in mind, everyone's situation is different, and this should not be considered advice to any individual listener. Let's dive a little bit deeper into their numbers. Go to the master dashboard. If we take a peek right up at the top, we can see there are more call units and call values to their stock. So just in terms of the options market, getting a sentiment here, looks like there's more people betting towards the company going up versus the other way around. Solid revenue here. In terms of revenue growth between 2018 up to 2021, it was negative 32% in 2018, negative 20 in 2019, plus 10 in 2020, plus 100% growth, change in their revenue in 2021. Massive returns in their revenue growth. That's something I really like to see. Keep in mind there were a lot of political tensions. There were reasons why things were backed up for a period of time. But then when people were out, they were consuming. They were consuming a lot. Look at the gross margins for the last 4 quarters. They're extremely consistent. I like consistency. Who doesn't as an investor, knowing what's coming up next? And taking a look at their operations, operating income looks solid. A lot better in comparison to the past handful of years that they've had as well. So the question I would ask myself is, why are they experiencing so much profitability in their operations right now? Why are their gross margins improving so much as well at the same time period? Another concern that I might have is looking at their net income last quarter last year, where we saw a really big dip in their net income. Now, I know they've had some changes within their manufacturing. I guess they're building a new location, so that could be a possibility that that slowed down production for a period of time. Something at least to be aware of. Here's what I find interesting on their balance sheet is their inventory has really piled up. Why isn't it selling? Why isn't it turning over as fast? Their turnover was great for the total year last year, 222%. So that's awesome. Like that's an awesome ratio. Hard to beat. They might have just overbought on their inventory within that period of time, thinking that people were still going to purchase more and more and more. I know their inventory was dried out for a period of time, so they might have just overproduced on their product. But it looks like they're holding on to a lot of inventory. So let's dive into that. This is their most recent transcript on December 2nd, 2021. All right, so this is interesting. Revenue from our second quarter was $230 million and $18.3 million, or 7.3% decrease from prior year second quarter, with nearly $13 million of the decline coming from our discontinuation of the Thompson Center product line. So that's a good thing to note. That's a really good thing to note. There's a reason behind the decline in revenue, and I can give it to that. I can give it to that. Obviously, they're moving, building a new product center, so obviously that's business. Here we go. In addition, we expect our internal inventory will continue to build during Q3 in our effort to restock after last year's complete depletion of finished goods inventory, and due to our mitigation of supply chain issues that all manufacturers have been dealing with, which we all know there's been a ton of manufacturing issues with the supply chain. That makes sense. Everybody's been dealing with those issues. But it really looks like they're trying to restock because of that complete depletion. Yeah, that looks good. Let's take a peek at their turnover and the history that we've had there. All right, so if we're taking a peek at their asset turnover, Seeking Alpha gives them a grade of an A+. They're at 2.4% when the median sector is at 1%. And Smith Wesson's 5-year average is just over 1% as well. So it looks like they're kind of crushing it in that area. If their turnover ratio is improving as it has been over the past 2 years, even if it stays the same, even if their turnover ratio stays the same as where it is right now, I'm not concerned with them having a higher inventory rate compared to normal, because it'll eventually deplete. Let's see what other analysts are saying about this. I want to see what their price targets are. I don't know if you guys can see that, but it looks like the average price target is 29 up here, with a high of 36, a low of 20. And if the stock's trading at 17 right now, just under 18, yeah, let's say about 20% on the low end. close to 65% is what the average price target is. Is that right? Yeah, that's huge. Like that's big. That's right. And that's big. That's where the value is. If the company can keep the company can keep their profitability levels where they are, continue to turn over that inventory, come out with some new products, finish their building their new location and moving their new location. Obviously, we understand that's going to have, some hiccups in their operations. We have to give them a break there. They might have missed a couple metrics on their financial earnings reports, but I mean, give them a little bit of a break. That's a good opportunity right now. If there's a big dip right after that, and I think that's why we saw a couple insiders buy into the company at that point in time, knowing that some of these pains and struggles are going to ease up a little bit more for them, and they're going to have some opportunities moving forward. Again, that's assuming their turnover and profitability margins, operation margins, continue as is or improve even more. Yeah, so all in all, some pretty good numbers by Smith & Wesson. I really think there's some good growth opportunity here. Their multiples are just so low compared to so many other companies out there. I really do think that there's some good opportunity here. I think what I'm going to do is wait for a little bit more of a pullback. They've been taking a couple dips here and there. So wait for a little bit more of a pullback and then start to ease my way into that position. So if you guys have found this video helpful or interesting, don't forget to like and share or subscribe. Also join us on the Market Interest Facebook page. That's where we can comment, have more of a discussion. And if you guys have any suggestions about other stocks, companies that you want us to review in the future, make sure you join the group and make some comments up there. All right, look forward to seeing you guys soon.